Great news for stock market investors and people in the United States in general, as on Wednesday, January 15th, 2025, the Bureau of Labor Statistics reported inflation numbers for the month of December that were better than expected. So in this video, I'm going to look at the details of that report and what it could mean for stock market investors. Let's take a look. I quickly wanted to let everyone know about this great offer for my channel members at the investor tier. You can gain access to my spreadsheet containing my ratings on over 130 stocks. I update this spreadsheet with multiple times and multiple changes per day, Monday through Friday. Additionally, channel members at the investor tier can get access to my spreadsheet with my discounted cash flow valuations, and I update this spreadsheet multiple times per week with multiple new companies added to this spreadsheet with discounted cash flow valuations. There's already dozens on the spreadsheet available now. You can get all this plus early access videos, plus member exclusive videos, plus priority response to comments, all for less than $15 per month. So what are you waiting for? Hit that join button below and start experiencing the benefits. All right, so the consumer price index for all consumers increased by 0.4% in December after rising 0.3% in November. Over the last 12 months, the all items index increased 2.9% before adjustments. But more importantly, the majority of the increase, well, I shouldn't say majority, but over 40% of the increase was due to rising energy prices, which rose by 2.6% in December, which means that everything else didn't increase by all that much. It was a blip because of the increase in energy prices in December, because of increasing sanctions on oil producing countries like Russia. And so the Federal Reserve, the central bank in the United States, tends to overlook these fluctuations in energy and food prices because they tend to be more volatile than other prices of things like services, haircuts, airplanes, things like that. So this is important because the Federal Reserve, the central bank in the United States, had started cutting interest rates because inflation was really trending lower. You can see this chart here for inflation going back to December of 2023. You can see after peaking in about February or March of 2023, 2024, you can see inflation trending lower for three consecutive quarters, 3 consecutive months, from 0.4 to 0.3 to 0 to negative 0.1. And this was happening while job growth was slowing down. And so this gave the Federal Reserve confidence that they can start lowering interest rates because they've held interest rates at a high enough level that's restricting economic activity. The central bank feels like there is a number, an interest rate, and the estimates are somewhere around 3%, that will not add fuel to the economy, and it also won't restrict the economy. That's what they call the neutral rate, or the rate that doesn't increase economic activity or decrease economic activity. When interest rates are higher than that number, which they are now, it's restricting economic activity. And the central bank does that when they feel like inflation is a problem, when they feel that inflation could get out of control. So they raise interest rates so that they can restrict economic activity. And the way it restricts economic activity is because people going out to buy things that are financed are seeing a higher monthly payment, so they're less interested in buying it. Things like homes and cars, right? You have a mortgage payment and a car payment that's directly connected to the interest rates in the economy. And when those interest rates are higher, it incrementally makes it more expensive to buy those things. And so you buy less of those things, and that creates a decrease in economic activity, which then brings down inflation because you're not going out and competing to buy those things. And so the merchants need to lower their prices in order to sell those things. And it's the opposite when interest rates are lower. More people are interested in buying stuff, and then those merchants can feel confident in raising their prices, which they have been doing over the last 3 or 4 years. And so that's causing inflation. But look at the worrying trend here in the last couple of months. In November, inflation ticked up to 0.3%, and now December, 0.4%. And so that's why you've heard Federal Reserve and central bankers, when they go out and make speeches, and even in their last meeting, they said that they were going to pause lowering interest rates because now they feel that they lowered interest rates a little too much because it spurred enough economic activity to cause an increase in inflation. And part of that they blame on the recent results in the United States election and the policies that President-elect Donald Trump proposes to implement, which could be inflationary. I made a video about that. I'll link to it at the end of this one. You can make those connections between the policy proposals and potential inflation. And so the numbers from today, because the large percentage of the increase was from energy, is likely to give central bankers a little bit of ease, a little bit of calm about inflation troubles. And so there was comments made that this new inflation number won't change expectations for a pause later this month, but it should curb some of the talk about the Fed potentially raising interest rates. Ellen Zentner, who is the chief economic strategist for Morgan Stanley Wealth Management, said, talking about these results today, because there was discussion that the Fed might need to raise interest rates to combat this rising inflationary problem again. They don't want to face the same issue. They don't want to let inflation get out of control. So today's number kind of eased those concerns. And that's why you can understand the stock market reacted very positively to this news. The S&P 500 was up by 1.75 percentage points, and the QQQ index was up by over 2.2 percentage points. Bond yields were down. The Russell 2000 index was also up. Cryptocurrency prices were up. There was an increasing risk appetite. There was an increasing interest from investors. And here's why inflation is important for investors. It's all about purchasing power. So if you have $100 and you think about the first year, your $100, let's say you're buying something that is priced at $5, you can buy 20 of those things. So your purchasing power can get you 20 of those widgets at $5. But if there's inflation in year 2 and you still have $100 and now the price of that item rises to $10, you can only buy 10 of those things. So while you still have $100, your purchasing power has been cut in half, right? You might think, well, I didn't risk my money. I put it under the mattress. I'm safe. I still have $100. Yeah, but your wealth was cut in half because of inflation. You can only buy 10 of those things. And now in year 3, if inflation rises to $20, if the price of that item rises to 20, you can only buy 5 of those. And so you've experienced in these 3 years a 75% loss in purchasing power. And so inflation impacts your wealth directly because of your purchasing power. That's something that many individuals neglect when they're making decisions about whether to invest in stocks or bonds or to just keep their money under the mattress. If you keep your money under the mattress, you're almost guaranteed to lose, because every year there's very likely to be inflation, and you're going to lose the purchasing power of your money guaranteed. At least if you put it into bonds or stocks, you're giving yourself a chance to beat inflation. And the reason stock markets rise when inflation is moving downward, especially when inflation is a bigger risk, is because now investors feel more confident about their purchasing power. So if investors in the stock market felt that inflation was ballooning out of control, they would want a higher return on their investment. They would require a higher return on their investment just to make up for the loss in purchasing power. And then on top of that, they would want an additional rate of return to compensate for the risk that they are taking. But when inflation is decreasing, the risk appetite for these investments increase, and so the values of these investments increase. There's a certain type of investment that benefits when the inflation is increasing, and these are investments of real assets, things like farmland, timberland, um, some type of real estate, because the replacement cost of those assets increases as inflation increases. These things are more directly correlated with inflation. And so when inflation rises, the price of this asset or the value of these assets also rise. They're more directly connected. Whereas if you own a government bond that's not inflation protected, some government bonds are inflation protected. They're called treasury inflation protected securities. But outside of that, if you own a government bond that's giving you 5% rate of return and inflation happens to be 6%, then you're losing wealth. And so you're less interested in those types of investments when you're concerned about inflation. And that's why you saw today bond yields fell considerably as a result of the inflation number, because bond investors felt confident that the rate of return on their bonds was not going to be eroded as much by inflation. All right, so I hope that explains a little bit about today's inflation number and how it connects to the stock market. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.